Nobody I've ever met wants to overpay the IRS. We have a $36 trillion deficit right now. So it's safe to assume the feds are some of the worst money managers on the planet. As a result, one of the number one topics we discuss with our clients is how to reduce their lifetime tax bill, and more specifically, whether or not they should begin converting some of their IRA dollars to Roth. In this episode, we're going to unpack what a Roth conversion is and ultimately discuss 7 reasons why you may want to avoid, reduce, or delay Roth conversions. Hello, everyone, and thank you for joining another episode of the Planning for Retirement podcast. My name is Kevin Lau. I am your host. I am also the owner of Imagine Financial Security. We help individuals that are over 50 who have at least $1 million saved maximize their retirement spending, minimize their lifetime tax bill, and worry less about the financial markets. If you are interested in learning more about how to work with us one-on-one, go ahead and visit our website at www.imaginefinancialsecurity.com, or you can start with the Retirement Readiness Questionnaire in the description of the episode. We look forward to learning more about you and how we can help you in your retirement planning journey. Okay, before we dive into today's episode, there is some big news, brewing in Washington. And this one is related to taxes on Social Security. So Roberto and I touched on this last week in our episode, but Social Security has a rather complicated formula to determine how much of your Social Security benefit is going to be included in your taxable income. So on the low end, actually, all of your benefit could be tax-free. So you might have 0% of your Social Security benefit included in your taxable income. But then on the high end, upwards of 85% of your Social Security benefit could be included in your taxable income. But Congressman Thomas Massie, who represents Kentucky, along with 29 other Republican co-sponsors, introduced the Senior Citizens Tax Elimination Act. Okay, so just to rewind the tape, prior to 1986, Social Security benefits were not taxable. And then in 1986, Social Security made some revisions there and came up with this provisional income formula to determine how much of your benefit is included in your taxable income. And that's where we are today. But specifically, Massie's bill would essentially repeal the inclusion of Social Security benefits altogether. Okay. And this also includes tier 1 railroad benefits. If you have a pension from working at the railroad, which could be a Social Security alternative, this also falls into that same category of potentially being completely tax-free. Okay, so this bill was first introduced last year. I've been kind of tracking this from afar, but now it's legitimate. Okay, it's in the House, and I just feel like it has a pretty good chance of passing. But I bring this up because there are costs associated to putting this bill into effect. All right, at the end of the day, our federal government, as I mentioned earlier, run a significant deficit. Okay, on an annual basis, about $1.8 trillion. I believe this year in 2025, it's expected to run about a $2 trillion deficit. The cost of this particular bill, the estimate so far, according to the Committee for Responsible Government, they're estimating this is going to cost taxpayers about $1.8 trillion over the next decade. Okay. And if we kind of couple that with currently Social Security's insolvency date, so essentially, just at a very high level, 80% of Social Security's benefits are funded by payroll taxes. So folks that are working now, employers and employees alike, contribute a certain percentage of their income into the Social Security system, into Medicare. And that's essentially how benefits are being paid out. Okay, but the other 20% is being supplemented by the trust fund, the Social Security's trust fund. And ultimately, this insolvency date is expected to be 2033. I've seen 2033, 2034, but somewhere in the realm of the next 8 years. And essentially implementing this tax-free nature of Social Security benefits really could accelerate the insolvency date of Social Security. So obviously, I point this out because the solution, how do you think they're going to pay for this bill? Okay, they're not just going to let Social Security go insolvent and benefits get cut. I mean, no administration is going to want to support that. How do you think they're going to pay for this is ultimately increasing taxes. Okay, that's my crystal ball. Okay, I believe taxes will go up in some way, shape, or form in order to fund the deficits that we have estimated for Social Security, for Medicare. Okay, and so I say this because generally we know what taxes look like today, but it is virtually impossible to be 100% certain about where taxes might be in the future. Okay, this is what I talked about last week on the YouTube channel. I broke down that Roth conversion example, and I just mentioned, this involves, knowing the exact value of this Roth conversion involves knowing exactly what your lifetime tax brackets are going to be and also what your kids' tax brackets are going to be. It's literally impossible. Okay. But with this episode, I'm going to talk about some circumstances that you might find yourself in, whether it be now or somewhere in the future, that might sort of cause you to kind of pause a little bit or sort of reconsider doing a Roth conversion, whether you delay that Roth conversion, potentially reduce that Roth conversion, or maybe you just avoid Roth conversions altogether. Okay. And so we're going to hit on these 7 situations. And I hope you guys find it valuable. If you do, make sure to follow our podcast. Make sure you subscribe to the YouTube channel. It really helps us impact more people, reach more people, which is what we're all about. But I guess, why don't we start with what a Roth conversion is? Okay. So really simply put, a Roth conversion involves moving or in essence converting funds from a tax deferred vehicle. So a traditional IRA, traditional 401k, traditional 403b, TSP plan, whatever your flavor of tax deferred retirement vehicle is. And you're essentially moving those assets that were once that are currently tax deferred, and you're moving those into a tax free vehicle. So in exchange for doing this, you elect to pay the taxes now. Okay. So why would you do this? Well, I recorded an episode way back in the day, early in the podcast. And if you're interested in this one, you need to go back into the PFR archives, if you will. Look for episode 10. The title is 6 Reasons to Take Advantage of Roth Conversions. Or you could just go into the show notes. We'll link that episode in the show notes. But really, in short, the reason you would do this, at one point in time, you believe deferring taxes was the way you wanted to go. Or maybe you didn't even have access to a Roth account. And this is pretty common, 20 years ago, 15 years ago, maybe we didn't have a Roth 401k plan available at your employer. But now you have the ability to do a Roth conversion to move some of those assets into Roth. But essentially at one point you were doing tax deferred savings. And now you're at the point where you're like, you know what? I want to go ahead and just pay some of the taxes now and convert those assets to Roth for the benefit of tax-free growth going forward. That is ultimately the benefit, in short, of a Roth account, is they have tax-free growth as opposed to tax-deferred growth. So in this episode, we're going to hit on those reasons on the opposite side. So again, the 6 reasons to convert, check that one out. But this episode, we're going to talk about these 7 scenarios where you may want to avoid or delay or reduce the amount you are converting into Roth. Okay. So why don't we jump into it? Number 1, let's just kind of get this kick-started, low-hanging fruit. You're in a higher tax bracket today than you will be in the future. So there might be several reasons this could happen. Okay. So let's talk about the low-hanging fruit on this one. You ultimately retire. All right. So let's say historically you're in the 22% bracket or the 24% bracket or the 32% bracket. Okay. But when you retire, your W-2 income goes away or your self-employment income goes away. So maybe your only income, maybe you have some capital gain distributions, maybe you have some dividends or interest income inside of your taxable brokerage account. Maybe you have a small pension or IRA distributions, but ultimately you believe, all else being equal, your tax bracket's going to go down pretty substantially. Maybe it goes down 10%. At that point in retirement, this could be an argument to not do Roth conversions now, but wait until you enter what we call the Roth conversion window, which is best after retirement and then before you take RMDs, before you start Social Security, or both. Okay. And so ultimately, your income might be temporarily high. Okay. And other reasons for this could be you sold a business, or you sold some stock, or you sold a rental property, or you had an abnormally large bonus, or you just received a large inheritance. Okay. And so doing a Roth conversion now or during those years might push you into a higher bracket unnecessarily, when you could, again, wait until that Roth conversion windows opens up, and then you could begin aggressively converting at that point in time. Another reason for this is maybe you live in that alternative universe and you believe actually taxes might go down in the future because of legislative changes. Okay, so therefore you might wait until Congress goes in and actually reduces and does further tax cuts, and that opens up the door for converting at a lower bracket at that point in time. But in short, the first point is you believe at some point your income bracket is going to drop, and therefore you could look at doing or evaluate doing conversions at that point in time. The second reason you might be in, or the second scenario you might be in is maybe you're leaving a high state income tax state and you're moving to either a low or a no state income tax state. According to the Tax Foundation on this one, state income taxes are a big driver for net migration in the US. In fact, the top third of states having so the top third in net migration net positive migration, the average state income tax was about 3.5%. The bottom third of net migration had an average state income tax rate almost double that, about 6.7%. Okay, now, first of all, do I believe you should move to a state in retirement just because of the low tax environment? Probably not. There are other factors that you want to consider, not just taxes. But if you're in a high tax state like a New Jersey or New York or California, and you're planning to move to one of these low or no state income tax states, you might consider waiting to do those Roth conversions until you move to that no or low state income tax state, because maybe your federal bracket drops at retirement, and then also you may not be paying very much at all, if any, in state income taxes. Now, it'll be really interesting to see how this shakes out, because companies are bringing people back to work. I mean, look at Jamie Dimon, look at JP Morgan, right? Look at Microsoft. They've been doing this for the last year. Amazon, Google, of course, the federal government. I mean, pretty much every employer is kind of moving back to this work in person type of environment. So it'll be really interesting to see if this net migration continues, especially for the folks that are pre-retirement, but certainly folks that are retired that have the flexibility to move to just about any state they choose. Of course, taxes are going to be a strong consideration. I'm meeting with a potential client next week who's moving from California to my state of Tennessee. And certainly I am certain of it that taxes, low state income taxes, was one of those considerations they made in choosing the state of Tennessee. Number 3, your heirs are poor. All right. So listen, I mean, at the end of the day, the 10-year rule, okay, the Secure Act that passed at the end of 2019. Okay, so the Secure Act, for those of you that don't know, I've talked about this in the podcast before, but it was retirement planning overhaul. Okay. But one of the key changes that was made in Secure Act 1.0 was really the elimination of the stretch IRA. So back in the day, individuals that passed away that had an IRA and left it to their kids could then stretch that RMD or stretch that IRA throughout the duration of their life expectancy. And if they're 25, 30 years younger than mom or dad, they're going to be able to stretch that account up much longer than otherwise they would have if mom or dad continued those distributions per the required minimum distribution tables. But the Secure Act 1.0 eliminated that for most beneficiaries. There are some exceptions. If you're leaving it to a spouse, of course, they can continue to treat the IRA as if it were their own, or treat it as a spousal IRA. If the beneficiary is less than 10 years younger than the initial IRA owner, they can follow those old stretch IRA rules as well. But ultimately, most beneficiaries for, let's say children, nieces and nephews, they're going to have to follow the 10-year rule. And ultimately, in short on this one, beneficiaries are going to have to liquidate the account in full by the end of that 10th year. Okay. And this has to do with traditional IRAs, but also Roth accounts as well. Okay. So Roth accounts still follow this 10-year rule. So they can't just necessarily keep it in the Roth account forever. But the big difference is the Roth account distributions during that 10 years of unraveling that retirement account are going to be tax-free to the beneficiaries, whereas the traditional IRA, that's going to be fully taxable. Okay. But the thinking is, if your beneficiaries are in a very, very low tax bracket, there could be an argument, and maybe you're in a higher tax bracket. Maybe you have Social Security, you have a pension, you have a large brokerage account that's spitting off a lot of taxable income. Maybe you're already in the 32% or the 35% bracket, or even the 24% bracket. And you're like, hey, you know what? My kids are in the 10 or the 12% bracket. Doesn't make sense for me to convert at my bracket at 24 or 32. I'm going to just wait, and I'm going to leave those assets to my heirs and allow them to pay taxes at a lower rate. Now, the tough one on this one is that this involves knowing exactly when you're going to pass away and what bracket your kids are going to be at that point in time. Because you may be thinking, hey, you know what? Little Johnny, who's 25 right now, maybe you're 60. Little Johnny's 25. He's not making very much. Maybe he's still in graduate school, okay? And he has no income. And you're like, yeah, of course, I'm going to wait to convert. I'm not going to convert these assets because his tax bracket's at 0. So if I pass away today, little Johnny's not going to pay very much in taxes. Okay. However, what about little Johnny's career? Maybe he's getting his master's now. Maybe his income potential is super high, or maybe he starts a business and all of a sudden he's in the 35% bracket or the top bracket 37, and you waited to convert it. Now 25, 30 years later, now you pass away and now he or she is paying taxes at that much higher bracket than you otherwise could have paid if you did those conversions. So it's very tough. I mean, that's why I said it involves having a crystal ball, knowing exactly what your life expectancy is, knowing exactly what your lifetime tax bracket's going to be, and knowing exactly what your kids' tax brackets are going to be. But I guess in this scenario, you kind of know a little bit. You know a little bit about the career trajectory of your beneficiaries, at least to a certain degree. You kind of know, you can kind of do your best guess here in terms of what kind of income potential your children might have or your other beneficiaries might have. And that could sort of help lead you to the conclusion of what you might do with regards to converting or not converting. But one thing I'll throw out here is, even if your son or daughter or beneficiaries are not in a high tax bracket, maybe they're in the 12% bracket, okay? Or maybe they're even in the 22% bracket. If you leave them a couple $1 million IRA and they're following the 10-year rule, they're adding another probably $200,000, $230,000 of annual income during that 10 years in order to make those distributions and unravel that account fully by the end of that 10th year. So your IRA distribution or your IRA legacy is ultimately could push them into a higher tax bracket, regardless if they're currently in one or not. So I guess this also kind of depends on like how large your tax deferred accounts are as well. Okay. So if your tax deferred accounts are, let's say, $500,000 and you have $1 million in Roth accounts already, maybe it's not as much of an argument relative to, let's say your IRAs are $3 million, your tax deferred IRAs are $3 million, and you have very, very little in tax-free money. So you need to look at sort of the distribution of taxable versus tax deferred versus tax-free. And then again, do your best guess in terms of what brackets your kids might be in order to make the final call on that one. But again, very difficult. Let's get out our crystal ball on that one. All right, the fourth one is related to hidden taxes. Okay, so any conversion, any Roth conversion, I mentioned earlier, you're going to go ahead and pay the taxes now in the year you do the conversion. So what that means is that income that you generate from that Roth conversion, even though it wasn't necessarily cash in your bank account, you are going to recognize that as ordinary income, as taxable income. And certain calculations in the tax code matter when it comes to some of these hidden taxes. Okay, so your modified adjusted gross income or your MAGI calculation, your taxable income, your provisional income, okay, or any other fancy calculation that the IRS likes to use in order to determine some of these hidden taxes. And so I'm going to just throw out a few of these. The first one is probably the most popular one is the IRMA surcharge, the income related monthly adjustment amount. So once you're Medicare eligible and you enroll in Medicare, you have a Medicare, A is free. Okay, you've already paid for A. But B, you have a premium. I think the premium for 2025 is somewhere in the neighborhood of about $185. And then your Part D, your drug premium is whatever drug plan you purchase. But if your income is above the threshold, so I believe there are 4 brackets, okay, 4 IRMA brackets. So once you exceed each of those brackets, you're going to pay additional surcharges, IRMA surcharges for both Part B and Part D. And those can range anywhere from $1,000 a year all the way up to over $6,000 per year per person. Okay. Another one to throw out there is if you retire before 65, and let's say you're using the ACA or the Affordable Care Act for your health insurance, you might be eligible for some premium tax credits. Because again, going back to what I mentioned earlier about your taxable income going down at retirement, this actually does play in your favor when it comes to these premium tax credits. You might be eligible for pretty aggressive premium tax credits. So even though, let's say, a sticker price on some of these ACA health insurance policies, maybe they're $1,500 a month or $1,000 a month or whatever that might be, you might be eligible for $800 or $900 per month of premium tax credits because your modified adjusted gross income is super low. The moment you start doing those conversions, depending on how much you convert, could essentially reduce or will reduce the amount of premium tax credits you're eligible for. Okay, so again, not saying don't do Roth conversions just to get premium tax credits or don't do Roth conversions just because you're tripping up IRMA, but it needs to be a consideration. Another one is the net investment income tax or the NIIT. This applies to individuals or estates or trusts that have modified adjusted gross income over the certain threshold. So for married filing jointly, if that's over $250,000, or single if you're over $200,000, there's an additional surcharge on investment income like dividends, interest, annuities, royalties, rental income, etc. And you're going to pay an additional 3.8% tax on that income. Okay. So again, not a reason to not do Roth conversions, in my opinion, but just to be aware if you're targeting a certain conversion amount, and let's say you go over another dollar and that all of a sudden trips IRMA or trips the net investment income tax, you might just reconsider and say, you know what, I'm going to convert a little bit less, still achieve the Roth conversion strategy that you want to achieve, but potentially keep you below those thresholds that you want to be aware of. Another one is capital gains, long-term capital gains. So capital gains taxes are realized once you take a paper gain and now you sell something for a gain and now it turns into a realized gain. So unless it's, of course, inside of a tax advantage account, like a 401k or an IRA or a 403b account, any transactions in there are not taxable. The only tax implication on those accounts is or when the income comes out of the account. That's when it's going to be taxed. But if it's in a brokerage account, if it's in a taxable account and you sell stock or bonds or mutual funds or ETFs or real estate or crypto or whatever that might be, and you have a gain, that tax that you pay on the gain is going to depend on your holding period, number one, but also what your taxable income is. So if you're married filing jointly, as an example, and your taxable income is below $96,700 for 2025, you don't pay any tax on long-term capital gains. So if you're in that scenario and you've got large unrealized gains in your taxable brokerage account, that could be a good opportunity for you to begin realizing some of those gains up to those thresholds and not pay any tax, and then reset your cost basis by reinvesting into something that is also going to align with your investment objectives and, of course, your retirement income objectives. So long-term capital gains is a big one. But again, not the end of the world, just something to consider. And the last one I'll throw out there in terms of phantom tax, I touched on this earlier, is just taxation on Social Security. It's just being aware of how this works. Again, on the low end, 0% of your Social Security income could be taxable. And then on the high end, upwards of 85% of your Social Security income could be taxable, depending on your provisional income. So again, just being aware of how the Roth conversion might impact your income, your taxable income, your modified adjusted gross income each year, and then making determinations on the timing of conversions, how much to convert, as well as whether or not you convert at all. Okay. Because, maybe there's an argument to say, you know what? I like this idea of tax-free Social Security. I like where I'm at right now. I'm not going to convert anything just because the tax-free benefit of Social Security is going to outweigh other long-term benefits that a Roth conversion might provide, just as an example. All right, number five. Number five is you're going to donate money to charity during your lifetime or at death. Okay. And I say this because traditional IRAs, these tax-deferred vehicles are some of the best accounts to donate to charity. Okay. And if you over-convert or you convert all of your tax-deferred assets into Roth, it sort of removes the benefit that these traditional IRAs could have provided you from a tax benefit. Okay. One example would be taking advantage of qualified charitable distribution. So once you turn 70 and a half, you can donate upwards, I believe in 2025, it's upwards of $107,000 from your IRA without you recognizing any taxable income. And of course, the charity, they don't pay any taxes. So the qualified charitable distributions is a super powerful tool once you turn 70 and a half. And again, it must come from an IRA. But what makes it even more powerful is that once you begin taking required minimum distributions, once you hit that beginning date for those RMDs, for most people, it's going to be either 73 or 75. You could reduce that RMD dollar for dollar up to that cap. I believe, again, it's $107,000 this year. So if your RMD, let's say, is $50,000 and you normally donate, $30,000 to charity, you might say, you know what? I'm not going to itemize my deductions. Maybe you're taking the standard deduction because you don't have any other deductions. Maybe you do $30,000 as a qualified charitable distribution directly from your IRA. And now instead of your RMD being $50,000, now it's $20,000. So it's better than a tax deduction. It's essentially making that income that otherwise was taxable to you completely tax exempt. So if you don't have a traditional IRA or tax deferred IRA, you can't take advantage of the QCD. And same thing on the back end at death. If you're planning to leave money to charity, your traditional IRA is a great asset to do so. Okay. We talked about the 10-year rule, and obviously beneficiaries that are non-spousal beneficiaries, most of the time, it's going to be your children or nieces or nephews that inherit those IRAs. They're going to have to pay taxes as they unravel the IRA via that 10-year rule, whereas the charity, they're not going to pay any taxes on that. So again, huge benefit if you want to leave money to charity, potentially looking at your traditional IRA as a way for you to satisfy some of those legacy goals. Okay. And again, this argument is not necessarily a function of not converting, but potentially not converting as much or as aggressively as otherwise you were thinking. Number 6 is you're planning to self-fund for long-term care costs. Okay. And so long-term care, we've talked about that on the podcast, talked about it with my clients many, many times over. Long-term care is probably one of the biggest risks, if not the biggest risk that retirees face today. Because it's one of those things that you may need it. You may need care at the end of life, but maybe you don't. But if you need it, how long do you need it for? Is it 6 months? Is it 6 years? I mean, is it some sort of cognitive decline, dementia, Alzheimer's, and all of a sudden now you need 10 years of care? It's just, there's so much uncertainty in that one. But if you needed care, you need to have a game plan. So, some people will go out and buy long-term care insurance. Some people use their own assets to self-fund long-term care. So what's cool about this one, and I'll bring this strategy up, is that you got to think about this idea of, your IRA distribution, of course, is taxable. Okay. But there's also a deduction. If your medical costs exceed 7.5% of your adjusted gross income, you can then add those expenses to your itemized deduction. So if you itemize your tax deductions, okay, so meaning you're taking more in deductions than the standard deduction provides, this medical deduction could then benefit you. And of course, if you need long-term care costs later on in life, it's pretty certain that your expenses are going to exceed 7.5% of your adjusted gross income, because long-term care is very expensive, upwards of over 6 figures on an annual basis. And so if you have an IRA that you can tap into later in life to pay for your care, you might be able to turn around, even though those were taxable distributions, you might be able to turn around and deduct some of those distributions because of that medical expense deduction. And while it may not be dollar for dollar on that distribution, it can definitely be meaningful enough and stand as an argument to against converting all of your IRA over to Roth. And number 7, I would say, is you just don't have the cash to pay the taxes. And I think many, traditionally speaking, okay, I'll say traditionally speaking, the textbook way to pay for Roth conversion tax is from cash on hand. That's just sitting idle in like a savings account or a checking account. Maybe it's increasing your withholding from sources like Social Security or a pension to kind of offset some of the additional taxes you might owe. But if those aren't options, okay, if you don't have the cash, or if you don't have any other income sources to increase your withholding from, or if you need the cash or the income from those other sources, the only option is you may just have to use funds from your IRA to pay the tax. And if you're younger than 59 and a half, you don't want to do that, because then you're going to be hit with a 10% penalty, okay, on the withdrawn funds. They look at that as an early withdrawal penalty. But even if you're over 59 and a half, certainly you can use the money from your IRA to pay the tax, but it just leaves less money invested inside of your IRA that otherwise would have been invested if you had used cash on hand to pay the taxes. So it may not be ideal, depending on, again, your time horizon, sort of looking at your break-even point of that Roth conversion, again, other considerations like your beneficiaries tax brackets, et cetera. But I would say your plan has to scream pro Roth conversions for it to make sense for you to pay the tax out of the IRA. I'm not saying it doesn't make sense. Actually, there's a client I'm thinking about right now where it does make sense. We are using her funds from an IRA in order to pay the tax, just because of the massive value it's going to add for her long term. She's a sort of that home run case study for Roth conversions. So maybe I break this down eventually on the whiteboard. But if you don't have the cash and it's not a scream pro Roth conversion plan, it might cause you to pause a little bit on the conversion or even avoid the Roth conversion altogether. So I hope you found this helpful. That's it for today. And if you did find this helpful, make sure to leave us that 5-star review. We need to pump up our reviews a little bit. Okay. We need to hit these on Spotify and on Apple. It just helps us reach more people. So if you're finding value in our content, if you listen to this whole episode, if you're at this point, you probably found it helpful. So go ahead and leave that 5-star review. I really appreciate it personally. It just helps us impact more people. It tricks the algorithm, their fancy algorithm that allows us to get, our podcast to be shown to more people. And so we really appreciate everyone that's already left that 5-star review. It's super, super meaningful to us. So again, make sure to follow our podcast. If you are planning for retirement and you're in that position, you're like, hey, I'd love to be work optional in the next few years. Or, hey, I just recently retired. I'm trying to navigate this whole retirement planning space. Of course, make sure to follow our show. And then make sure to share this with someone else that you think would also find value. If you're listening to our podcast, if you've been a listener for a while, you know what we're about, you know what we talk about, and you know people in your life that would benefit from listening to our content. So just make sure to do me a favor, share that with someone that you care about, that is in a similar boat as you, and that would also find value in our content. That's really it for today, everybody. I'm looking forward to next week. I'm going to do a whiteboard retirement plan breakdown for the next episode. So that's going to be super juicy. I'm looking forward to that one. And the whiteboard fireside chat, I'm still up in the air in terms of the episode I'm going to do on the YouTube channel next week. But of course, make sure to subscribe to the YouTube channel. We're doing weekly whiteboard fireside chats where I just go a little deeper into a specific topic, whether I hit it on the podcast that particular week or just from a client scenario or client case that we found interesting that we wanted to share with you, PFR Nation. As always, that's it for today. Thank you, everyone, for tuning in, and I'll see you next time.